This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Xavier Segura of Tessera Venture Partners. Xavier, thank you for joining us.
Al, pleasure is all mine. Thank you for the invitation.
Great. So what was your background before investing in early stage companies? What did you do before this?
So prior to Tessera, I've operated, grown, and helped exit a number of technology companies through the startup and enterprise stage. I'm kind of in those roles, mainly business development and product roles. So I was an early member of AppNexus, which is a technology ecosystem used for digital advertising, and then went on to work at Verizon, where I was a member of their technology group responsible for kind of a number of their digital advertising projects and the acquisitions of AOL and Yahoo. And it was actually there too, Hal, where I met my co-founder. He was actually one of my vendors. I was his client. And we went on to become friends, and he recruited me to come join him at Oracle, not Tessera at the time, where I joined Oracle to be part of their data cloud business, where I helped create data strategies and data products for publishers, large websites, and our agency clients. And later on, grew to form Tessera Ventures with my co-founder.
Great. So what excites you right now?
At this point, there's a ton of very interesting things in this space. And by space, I mean what we look at Tessera. So at Tessera, we are very interested in the world of data and really data innovation. So on that side, one can't help but to be excited about blockchain, and specifically how now blockchain is getting applied to a whole host of different industries, and specifically the distributed ledger technology. So that is sort of a thing in the back of my mind that I look for in different investments, and specifically not how companies are building brand new protocols, but how they're using existing pipes to solve longstanding business challenges. So specifically one that is an area of focus for this year and the coming years will be the increased digitization of assets and securities. I think that is going to be a massive area to reduce a lot of the friction that occurs within a lot of trading today, and also just developing new asset classes. Also, one is very excited about what is occurring within the gig economy today and how to properly evaluate and score members of that economic sequence. And really, I think fintech tools are going to be largely responsible for how to develop new ways of scoring credit and new ways of identifying lifetime customer value, which had not been seen before. So really, those are probably two or three of the areas that kind of excite us right now. And I think also at this time, we're also very excited to launch our second fund, Hal, off of the heels of our inaugural first fund. We have an opportunity to increase exposure into our Fund 1 companies alongside with 10 or 20 new investments.
Well, great. So what's your advice for people investing in fintech, blockchain startups that you deal with? What do you tell them to do before they write that first check?
I think it's so easy, Hal, to kind of get caught in the weeds, get caught up in the technology. I think for myself especially, we're product and tech guys, so we really geek out and get excited by what we see with the CTO or founding technical team. But it's really important to take a step back and analyze the core problems and understand, before going too deep into the tech, what problem the company is trying to solve. And specifically, is it a problem that is capable of being solved? And how long that might take before you can start seeing some incremental progress and thereby start really creating some value. And hopefully that translates into enterprise value, where a company can continue to grow, receive greater amounts of funding, and hopefully come to some sort of an exit. So the other thing that I would really kind of advise fellow investors or folks just enthusiastic about tech and tech investing is to continue to scrutinize and look for cash efficiency. Really, this has been something within the last couple of years that has been a product of very large runway valuations, very large macroeconomic forces where we've just been in a bull market for the largest bull market we've ever seen here in the States. So I think that now there's really a turn towards how can companies turn POCs into contracts? So the ones that are successful at convincing a large enterprise company to work with them, really, how can they start now convincing them through the attentiveness of their product team and their support teams to turn those beta tests into recurring revenue streams and thereby making their companies even more efficient?
Well, that's good advice. And so on the other side of that table, what do you tell people that are running startups? You talked about being cash efficient, but what else would you advise them to do before launching that startup?
I think part of that is really looking to license instead of looking to build, which is kind of counterintuitive for a tech investor to say license technology. But I think part of the issue is in an increased effort to differentiate, so many companies will want to build it themselves. And that isn't always the most efficient use of capital or specifically resource, whether that's time, whether that's human capital, or even just timing within the market. So now if we look at something like blockchain, there are so many existing protocols or toolkits that are available to companies today where that necessarily wasn't the case. There weren't a large army of blockchain engineers 5 years ago. There aren't a ton of them now, but they're certainly much more available than in years prior. So that allows for a reduced barrier to entry to a lot of companies that are looking to, whether it comes to something like blockchain, incorporate that solution into their existing stack. So that goes into kind of the second piece of advice that I have, which is prioritization. So on one side, looking for ways to obviously chase a big market. Product market fit will continue to be the kind of the guiding principle for an investor in the space. But really understanding, is there a way that I can address a market today, maybe pick up some singles and doubles, while also building out my home run, my game-changing idea? And I think that also helps companies continue to grow. It also implicitly creates pivot opportunity, which can be beneficial to both the company and the investor, but also bakes that into their product strategy and their product roadmap.
Great. Well, let's talk more about the state of investing in fintech and blockchain. How is the industry evolving? What changes do you see coming up?
Well, I think one of the big changes is just what's happening with nomenclature. So specifically, the public and investment community has grown a lot more comfortable with moving past buzzwords. It used to be the case, Hal, where if you had the word blockchain or AI or machine learning on your website, not only would that add cachet to your SEO, but it would also add some points to your valuation. And I think that that's still happening today to an extent, but really a lot of investors have grown much more savvy, much more comfortable about looking past that to really try and define, as we do at Tessera, what is the critical business problem that can be solved using that technology. So we focus more on problem solving and not necessarily what the actual buzzword is that's being used to solve those problems, as in a AI focused platform for blah, blah, blah. We're simply now seeing kind of more of an enterprise approach, which is we bring down the cost of insurance, for example, or we can approve a loan in 5 minutes and disperse cash in 5 days. So you're seeing a lot of startups, a lot of the fast moving startups adapting a lot more of an enterprise or public company approach when it comes to talking to their solutions rather than looking for the buzzwords. And I think that's also a byproduct of increased savviness on the side of the investment community.
So let's talk about regulatory for a moment. In the fintech world, there's a great deal of regulation, and blockchain brings a lot of new technologies that challenges some of those regulations. How do you see fintech and blockchain dealing with the regulatory groups today?
I think that's a great question. With the world of regulation, the temptation there is to create a smart contract that will just be able to execute every T and C without any issue and cheaper than it's done today, and also more profitable, right? So I think there is no sort of magic wand or cure-all when it comes to incorporating blockchain into a regulatory framework. But the real guiding principle is understanding that finance is a relationship-driven business. And what we really love to see are existing companies that have already created regulatory frameworks in place. For example, let's call it legacy banks and financial institutions. Right now, every major bank has a head of digital assets or digital securities. So that necessarily wasn't the case maybe 5-10 years ago. But now you're sort of seeing that change from the inside out. And really, when it comes to a blockchain framework, you're seeing a lot more of a growth between private blockchains. As I think that is going to be the logical progression for where the market is going to be moving. The kind of open, unregulated trend for some other types of technologies really wouldn't work within the financial regulatory framework. But one example from our portfolio, Figure, has managed to solve this pretty spot on. Really, they were a team comprised of the former founders of SoFi. So they already had some experience with the world of lending. And within that, they realized that there were still further efficiencies that can be made with the blockchain. So I think it's important to look at what blockchain is good for and what it's not good for. Blockchain, in this case, for Figure, was really great at reducing the amount of middlemen in a transaction and bringing down the cost of a loan. It's not necessarily a solution for solving all of the legal complexities that can occur on the back end. I think those have to be planned out in accordance with the SEC and with other regulatory bodies, but it is starting to become much more accepted as greater amounts of financial institutions start to enter into the arena. Obviously, JP Morgan being one of the leaders right now in the space.
Very good advice there. What about your investment thesis for your fund? Can you tell us what that is and what you look for specifically in a startup that you want to invest in?
Absolutely. So at Tessera Venture Partners, we're an early stage venture fund that will invest really in transformative companies. And by transformative, we mean companies that are doing something large within data innovation. Really, data continues to grow exponentially every year. And so right now, that's not necessarily a competitive advantage. The competitive advantage is how to make sense of the increasingly large amounts of data sets, how to make quicker decisions, and how to make more accurate predictions using sort of the past results. And I think there are a couple of tools that exist nowadays that are making that a little bit more simple. We mentioned blockchain before. That certainly is a way that I think is used to structure and re-engineer different databases that can house information and create new sequences that previously were not possible, and obviously a new level of security that was not possible. And AI really is something that has been around for quite some time. It's probably called a whole host of different things from R&D to its current state, but really being used as a way to make predictions and to synthesize that data that's getting used within a database. So really, for us, if those are the tools, if those are the colors, when it comes to creating value, the painters are the founding team. And we only invest in extraordinary founders. In our first portfolio, we invested in founders and CEOs that all had large exits within their prior companies. And we especially look for founding teams that have kind of an itch to scratch. Maybe they were successful in their prior company, but the technology that they were looking to build just wasn't quite there, or they were looking to do something even greater. And now this is their second go around. And finally, at Tessera, we highly value diversity and inclusion. We really feel that having teams that are both diverse backgrounds in ethnicity or in gender can create better products and lead to better enterprise value.
Very good. So can you talk about one or two startups that fit that thesis?
Absolutely. So one of the companies that we mentioned previously, Segura, is a company that creates loan and lending products using blockchain technology. And sort of one of their key products right now are home equity loans of credit, or otherwise known as HELOCs. And they originate the HELOCs on the blockchain. So here we have kind of all the check marks being hit, Hal, where we have a veteran team from SoFi. We have a market need getting addressed, in this case, lending and bringing down the cost of that lending. And we have a extreme use of data within the solution where Figure is able to reduce the amount of time to approve someone. If everyone and any listener has filed or attempt to file a HELOC before, they can know the pain where it'll take sometimes weeks to finish the process and then weeks further to actually receive a disbursement. Figure can do this in 5 minutes as far as an approval is concerned, and then with cash out in as little as 5 days. And another example of a company that we really love that embodies this motto is Dream Payments. Dream Payments is a fintech and insurtech company founded in Toronto, Canada by CEO Brent Ho Young. And really what they're doing is providing payment technology to banks and financial companies and insurance companies. And I think fundamentally what we have here is many financial institutions are not technology companies. In fact, none of them are. Really, the hybridity between finance and technology allows companies like Dream Payments or like Figure to exist, where Dream Payments has a set of APIs, libraries of APIs that they can give to banks in order for banks to give greater payments and services to their clients. And that allows the bank to focus on what they do, relationship management, cash management, and other financial services, and leave the technical rigor and operation to Brent and the rest of the team at Dream.
Well, those sound like some great startups there. Well, let's talk about the challenges in this space, fintech and blockchain for the startup. We talked about regulatory, and of course, there's many other challenges, but if you had to pick the top one or two that you see your startups dealing with to get the product up and off the ground and get the company moving forward, what would you call that out as?
I think that's a great question. And obviously the regulatory challenges are pretty well known, but I think that present an opportunity for startups to become really some of the leaders and some of the most nimble players in that space. So one of the challenges within that is kind of fighting the J curve, the famous J curve where companies like Apple are so good at, where they can just seemingly create large revenue generating products year after year and kind of achieve growth and then plateau out. It's much more challenging for young companies to do this. And especially nowadays, they have to be very mindful of customer acquisition costs, especially in the world of fintech. They have to be mindful of who they're competing against. Right now, there is a huge macro climate of consolidation, as we've seen lately with the banks. And that means increased customer acquisition costs, right? Because now you have sort of these large Goliaths bidding up the cost of regular consumers, even on some estimates, more than $1,000 or $1,500 to acquire a single customer. And I think that also creates an opportunity, as we mentioned, for startup companies to know, okay, I can be very efficient with the way that I'm targeting my service to acquire my customer. But obviously that implicit challenge that we mentioned of the J curve, if they can sort of get past that hump, if they can figure out a way to be efficient in using their product to attract new customers, they'll have to hold them on long enough and get hooked enough into their offering, into their company, to where they can start to either monetize from that existing customer, or better yet, entice them with other goods and services. So I think really for all companies, keeping an eye on customer acquisition and customer retention, especially within the world that's consolidating of fintech, is critical for their success.
Great. Well, you see a lot of applications out there in different subsectors. If you had to pick one or two that you think are good immediate opportunities for investors to pursue today, what would you call out?
As far as the areas right now that are that are most interesting. I think we've mentioned some that we're pursuing here at Tessera. One of those areas is just the increasing digitization of assets. I think that's going to be a major force when it comes to looking at companies that are going to be popping up over the next year or two that are seeking capital, and really ultimately that's one of our main points on the thesis is to identify large markets and to identify teams that have the best chance to really capitalize on that. So that would be the advice that I give to other investors, is to look for those markets. We believe that to be in the world of digital assets and securities. And then another is the debt markets, and specifically how debt is valued on the pre-sale side. So how are companies scoring potential customers and clients? And so obviously we remember the famous lending club, lending tree examples in the past, where there were literally thousands of data points drawn from a potential customer before a decision was made. But ultimately it was about 4 or 5 nodes of information that drove yes or no when it came to a loan. And a large factor of that was obviously credit score, which is not too different or too dissimilar from conventional financial companies. Therefore, I really have been looking for and have started to see a few companies that are doing novel innovation and really kind of moving towards understanding cash flow of individuals or of underbanked consumers in the financial economy, or really the gig economy, which is where all the banks want to compete and really where everybody is going to look to create alpha for the next coming year.
Well, very good. Well, in the last few minutes that we have here today, what else should we cover that we haven't?
I think we pretty much touched on the main points today. I would say that overall, to be very excited about the upcoming year or the upcoming 2 years. I think right now the quality of companies, both that are coming out of incubators or that are teams that have transitioned from former banks, I think that disruption is real. I think that is going to be creating a tremendous wave of new companies. And the important thing is to stay focused. And this is going to sound like a contradiction now, but it's really important to kind of do both, to stay focused, but at the same time, be open-minded enough to be able to respond to growth waves that are just unforeseen. But it all kind of dates back to the initial thesis we talked about, which is, can a company address a problem in the market and specifically start to move towards a solution of that product incrementally and really create enterprise value that way?
Well, that's great. Well, how best for listeners to get back in touch with you?
I'd love to chat with anybody who has any more questions or is curious and reaching out to us. Best way would probably be through our website at tesseravp.com. And I have our contact info there for anybody who's looking to get in touch with us.
Great. We'll add that to the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Thanks, Al. It's my pleasure. Absolutely.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Halti Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinions of Investor Connect. This podcast is for informational purposes only and should not be relied upon for the basis of investment decisions.